Customer analytics, using data to drive decisions. Segment price and predictive, fueling career ambitions. Who buys more and why and when? What brings customers back again? Data or machine learning? Happy customers, jobs worth earning. Customer analytics, using data to drive decisions. Segment price and predictive, fueling career ambitions.
Thank you for letting me run my conditioning experiment on you for the last 9 weeks. I feel like that song is about 8 seconds too long. And next year I might even pay for the 1-month subscription to. Okay, so the farther you go in your career, the more you're going to be expected to work across disciplinary boundaries. And this will be especially true if you start your own company or if you ever reach the C-level in a corporation. So today we're going to look at a couple of topics at the intersection of marketing and finance. I have a bunch of dear friends in finance. I think finance is a really interesting discipline. I am certainly not an expert, so I sort of wade into these waters with some trepidation, but I do know enough to say that there are some areas of substantial overlap between marketing and finance, really between any pair of business disciplines that you might consider. And I think given the size of the overlap, I find it surprising how seldom I meet someone who's an expert in both areas. So when you have an undersupply of complementary skills, that's an area of opportunity, and that's what I want to explore today with these two topics. These two are things I think are really accessible where you guys are, and also have long-term implications. There are a bunch of other areas we could look at. There is a substantial literature looking at how stock prices react to various market and strategic decisions that companies make, such as product recalls, product launches, advertising campaigns, price changes. We saw that in the Netflix case example, the stock market reaction to the initial price increase and then the branding split. There are internal negotiations because finance is typically the area in the firm where other parts of the firm get their budgets and have to report back their productivity. Finance often gets involved in evaluating market opportunities, including major new customers, product launch budgets, how things are going to go. And we have this area called behavioral finance, which is a very small part of the finance discipline, but starts from the undeniable premise that most investors are human beings, and therefore they have perceptions which may depart from reality. They may have various biases, and it's a powerful simplification to assume that investors are rational and fully informed and always profit-driven, but it is a simplification. The reality is more complicated, and by modeling the additional complication, we can better predict investor decisions. Now, these two areas in the business world are far enough apart that actually we have some careful research documenting some of the differences in the people who self-select into them. So for example, finance professionals, so there are these big 5 personality traits that psychology has mostly converged on to describe human personalities. And this paper finds that people who study finance are less neurotic, where neurotic is sort of a catch-all term for the general incidence of negative feelings of many different types, and also more conscientious than the population at large. Whereas people who self-select into marketing tend to be more extroverted, but also less agreeable than the population at large. So you even get different types of people pursuing different paths to some degree. So I think that partially explains why, even though the Venn diagram has an intersection which is not that small, we don't find many people who really study both areas. So we're going to go into spend quite a bit of time today on two topics in that overlap. By the way, how many people here hope to become finance professionals in the future? And how many folks hope to become marketing professionals? How many neither finance nor marketing? Yeah. And how many both finance and marketing? Okay, we've got all four quadrants of that 2x2 represented. So corporate valuation is a discipline within finance and accounting, which seeks to attach a number to answer the question, how much is a business worth? That's the valuation part of it. We're going to try to figure out how much a business is worth. Now, valuation is always going to be a forward-looking prediction. Because if the business were to go bankrupt tomorrow, the business should be nearly worthless today. So predicting the future is inherently subjective. There are many ways to do it, and different people may come to different valuations. So if you really want to know how much a business is worth, there's a single way to do it, and that is to offer it for sale. Try to sell the business or a piece of the business in an auction. Oh, hey, Radim. I invited Monday students here, but I didn't promise to give them credit for contributions because that'd be unfair to those who couldn't come. So you'll have some folks in here who, yeah, are not on the roster. So, and thank you so much for you Monday folks who joined us today. Really happy to see you. So if you want to know what something is worth, you take bids, you sell it at auction. But there's going to be a lot of times that we want a number without actually selling the thing. So for example, if we want to borrow money and we want to offer part of the business as collateral for the loan. Or if we are trying to value employee options, or if we get sued over some of our past actions, and we need to come up with a fair estimate of the value of the business for fair compensation in a lawsuit, or to determine how much insurance we should get. But there's a bunch of different reasons that we would want to come up with an estimate of the corporate valuation without actually selling the thing at auction. And since this is inherently a subjective process and often might be potentially involved in a legal proceeding, we want a standard approach as much as possible to come up with that valuation. And so this field of corporate valuation, it looks a lot like kind of like a house appraisal, where they'll have standard approaches to determine comparable houses that have sold in the market recently to try to inform what any particular house appraisal might come to. So we're going to go through some of those formulas. And the formulas I'm going to be presenting come out of what I can tell is the field leading textbook written by accounting professor at NYU with named Demoteron. So we're going to use capital T to indicate the net present value today of given all the information that we have available up until today. So this is kind of a shorthand that's going to indicate net present value. So the value of a company is going to be today's value of its operating assets plus its non-operating assets minus its net debt. And things like non-operating assets includes anything on the balance sheet, which it doesn't use to operate in its market. So if your company buys a bunch of Bitcoin and holds it, hoping it'll appreciate, that would be an example of a non-operating asset. So we're going to focus in on the operating asset part of this because that's the part that's going to be customer relevant. And the operating assets value is going to be a net present value, where on the denominator we have the weighted average cost of capital. And in the numerator we have the free cash flow. And we're summing up the discounted free cash flows across all future time periods. So this might look a little similar to CLV that we saw a couple weeks ago, or was it last week? And to get a little more specific on the free cash flow, that's going to be defined as the net operating profit after taxes minus the change in capital expenditure and depreciation and amortization minus the change in non-financial working capital. Now, out of these four terms, the profit function is going to be the most customer relevant. You can make an argument that things like brand valuations could go into non-financial working capital. So this one is not customer irrelevant, but we're going to zoom in on NOPAT. Most of you guys took accounting, right? Did you study NOPAT in accounting? Yeah. That's what it stands for, yes. And this is the formula for NOPAT. It's going to be your revenue times 1 minus the variable cost ratio. So essentially, this is total contribution that we've been studying in here, less your fixed cost. All of that times 1 minus your tax rate. So this is the first thing we've gotten to that actually looks like a profit function, and that's what P in NOPAT stands for, is profit. Okay, so if you are with me up until this point, this is where we can do better, and that's going to be the innovation offered by customer-based corporate valuation. So the traditional way to predict future values of NOPAT is to look at past values of NOPAT. It's a univariate time series. Which is a very simplistic way to forecast changes in something that has quite a few different moving parts. And the core idea behind customer-based valuation is to say, rather than use past realizations of this formula to forecast future realizations, we could forecast multiple components within this formula and use those to calculate future realizations of the formula. So the reason this is a really valuable thing to do is that firms can realize profits using different types of strategies. And in particular, we can define 2 attributes of the firm's strategy that can be, they have dramatically different implications for future profits. The first strategy attribute would be something that I call promotion focus. So firms that spend a lot of money to acquire a lot of new customers, so they tend to have high customer acquisition cost. But because they attract so many new customers, a lot of those customers are not going to be right for the firm for the long term. And a lot of those customers will end up churning. The second one is what you could call retention focus. That is a high degree of satisfying current customers. And by giving customers a great deal, you're going to tend to have them coming back at a higher rate. So you'll have lower churn, higher CLV, and generally speaking, lower customer acquisition cost. And so a retention-focused strategy is going to pay off over a longer term than a promotion-focused strategy through the higher customer retention. And so the idea behind customer-based corporate valuation is to use customer-level data, which many firms already track internally, to measure past promotion and churn or retention to come up with better estimates of future NOPAT. So this gets done. There's two roughly equivalent ways to do this. The one that was proposed in the original customer-based corporate valuation paper is called tracking the customer, or the C matrix, where we're going to track every cohort of customers, where we define a cohort as all the customers acquired within a certain time period. It's oftentimes a month, but it could alternately be a week or a quarter. And then for every subsequent time period, we'll measure how many of those customers remain with the firm. Now, the other way this gets tracked internally at a lot of startups is what's called a triangle retention chart. So the C matrix is here on the left, the triangle retention chart is here on the right. And the only difference is whether you're using absolute time indices, as in the C matrix on the left, or relative time indices, as in the triangle retention chart on the right. So say you're looking at a startup and it's 6 months old, which means it's been operating in the market for 6 months. So it's got 6 cohorts of customers. Here, the time indices index months on an absolute basis. So this could be like January, February, March, April, May, and June. And then the contents of the matrix would show how many customers acquired within a particular month remain active in each subsequent month. So for example, in the first one, we have how many customers acquired in January. Second one, how many customers acquired in January remained active in February, all the way down to June. So by looking at trends in retention across months after acquisition within a cohort, you can estimate future retention. And this turns out to work really, really well. And I'll show you data in just a minute. So this idea, it works best when churn or retention can be directly observed. And so that is the case in subscription business models where someone has to cancel in order to quit. We can also extend this idea to what are called transaction business models. However, with transaction business models, we don't always see when a customer has churned. So we have to estimate a few other aspects. So it's a bit more complicated, and therefore the predictions are more volatile. We can look at how often people transact, look at how much they spend. It's kind of like the customer metrics we opened with last week. So this framework first got my attention almost 10 years ago because a friend of mine, his name is Dan McCarthy, he was one of the original developers of this framework, co-author on a couple of papers as well. He published a post on LinkedIn about Blue Apron. How many of you guys have heard of Blue Apron? Yeah, very famous company. How many of you guys have purchased Blue Apron? 1, 2, okay. Maybe some of you were too young. Very, very famous company. Blue Apron went public in mid-2017. And the numbers on the left here came out of the pitch deck, the pre-IPO pitch deck to investors. And marketing costs as a share of revenue hit 25% in the quarter before Blue Apron went public. Now, if you've ever seen data like that, this would make your eyes pop. So typically, 8% of revenue is a really high marketing budget. So to see triple of what would normally be a really high marketing budget in a pre-IPO company, this is very, very surprising. And Dan predicted that this IPO would not hold its value because this is a strategy you can reasonably call pump and dump. We got a whole bunch of capital from our prior investors. We spent way too much of that on growth, acquiring customers who probably are not going to stick around. We became very, very famous. And Dan was right. Within 2 years, the stock had lost 90% of its value. So that was the first time this kind of got my attention, like, oh, okay, it seems like there's really something here. Any questions or comments there? Now, this happened right around the time that card spending panel data started becoming available. We looked at that card spending panel data last week with those economists who analyzed the entire Visa payment network transaction database. Now, whereas customer-based corporate valuation started out as a call for companies to publish their customer retention numbers by cohort, all of a sudden, once we got card spending panels, we didn't need the companies to publish that anymore because we can go and estimate that directly using card spending data. Because we can see which cards purchase from which merchants and how many cards continue purchasing from the same merchant repeatedly and how that changes over time and how that changes by customer cohort. And so the major market for the card spending panel data providers is investors. So I'm going to show you 3 brief case studies, which look at how trends in customer retention before the COVID-19 pandemic correlated with outcomes a few years after the COVID-19 pandemic. The one thing you need to know before we look at these data is that the stay-at-home order approximately doubled the size of the e-commerce sector overnight. It was an enormous shock to e-commerce. And all 3 of these firms are strongly related to e-commerce. So the first case study is Instacart. Now, on the left, we have detrended detrended quarterly revenue for Instacart in a large card spending panel data set. You can clearly see a lot of people didn't want to go to the grocery store for a while. So Instacart benefited from that. Now, on the right-hand side, this is card spending panel data. And every line that you see on this graph is a cohort of customers acquired who first transacted with Instacart in the same month. So we have several dozen different cohorts of customers, each represented with its own line. Every cohort has 100% retention in its first month interacting with Instacart by definition. And then in the following month, you can see very strong trends, both across cohorts and across time periods in retention rates. So if someone interacts, if they pay Instacart for the first time, their chance of paying Instacart again the following month was around 20% in 2017. And that was trending down a little bit. But after the pandemic, it leveled out and it increased and it stopped its downward trend. So Instacart did really, really well in retaining customers during the pandemic, much better than its prior downward trend. And Instacart came out of that period of heightened demand with a very healthy balance sheet. Yeah.
So essentially, for like the health of the business, would it be more preferable to like focus on retention rather than acquisition? Like more so in the long run?
I think it's hard to make a general statement, because a lot of it is going to be contextual. In certain settings, acquiring a customer could be really, really expensive. In other settings, retaining the customer could be really expensive. The strongest thing you can do to retain a customer, cut your price, right? That's directly increasing customer surplus, but it's hurting your margin. So how do you balance that versus the acquisition cost? So ideally, you want to acquire cheaply and retain well while getting a high margin, but you have to sacrifice somewhere. And so where is the right place to sacrifice? I think that's hard to generalize about. But the risk that we're trying to guard against here is we pay too much for a business that is focused excessively on growth at the expense of retention.
How would you respond to the basic advice often offered in business that it costs more on average to acquire a customer than to retain?
Yeah, a lot of people put that number at 5 times more to acquire than to retain. I've seen it as high as 25 times. I've seen it lower, like 3 times. And that is consistent with the idea that if you're a forward-looking investor, you want to be able to measure recent customer retention, because there's a significant chance that the business is for sale because it has been retaining poorly and therefore could become a liability in the future. So 2 more quick case studies. DoorDash had been trending up before the pandemic. Retention rates boosted and remained high throughout. And DoorDash became one of the category leaders to a greater extent than it had been in 2017. Now, the last case study, which is a bit of a more negative result, is a e-commerce shipping company called Shipt. Retention had been going poorly before the pandemic, with uniformly declining retention rates across cohorts and time. The pandemic didn't do anything to change that, despite the big spike in demand. And Shipt sold very cheaply to Target a couple years later. So this is not perfect evidence, but I think it strongly validates the idea that past cohorts retention rates can predict future cohorts retention rates pretty well, despite some noise in the data. And therefore, we can pull apart the components of NOPAT to come up with better future predictions of what NOPAT is going to be.
What value does a poor performing company bring to a larger company to buy out? Is the brand image?
In this case, yeah, it's hard to say. Sometimes it's acquiring the talent. Yeah. So there was industry discussion that Shipt had been offering itself sale at a much higher valuation a few years before Target made the acquisition. So it did not look like a successful exit for the founders. So a couple weeks ago, I was looking to see, I've been teaching this for 4 years, and I hadn't updated like what progress is customer-based corporate valuation making in the marketplace. To me, this just seems like such a sensible idea. You know, why isn't this standard, or why hasn't been standard for a long time? And it does look like there is progress. So the SEC in 2020 started asking registered companies to more often disclose the operational KPIs that they use to run the business, including customer metrics like churn and customer acquisition cost. There was a detailed Morgan Stanley paper that I linked to down here, which went into detail about CBCV for sell-side analysts. The Federal Accounting Standards Board invited a round of comments on how to account for customer relationships as intangible assets, and asked its stakeholders whether it should or pursue creating uniform measurement and disclosure standards. It hasn't made a decision yet, but it has received comments. Our friend Professor Damodaran has written a recent paper talking about requiring subscription-based businesses to disclose acquisition costs, contribution profitability, and cohort retention tables. So that's the gentleman who wrote the market-leading textbook. And he talks about how to use those disclosures in valuing companies like Dropbox or Slack. And last year, one of the major accounting firms mentioned that the SEC is often requesting companies to disclose specific results of operations, new customer revenue, and more granular determinants of NOPAT rather than simply the univariate NOPAT time series by itself. So it looks like there's momentum in this direction in the marketplace. So the last question I think that is kind of worth filling in is how many companies are actually tracking the customer level metrics that would enable more comprehensive disclosures. And this paper published in an accounting journal in 2024 surveyed 300 large corporations about which customer metrics they tracked. There's good news and bad news. The bad news is that for most of the customer metrics, the majority of companies say they're not actually tracking those internally, which to me is a little bit crazy. However, the good news is that when those customer metrics are being tracked, the majority of companies tracking them say they do disclose them in some form. However, the disclosures are not standardized or systematic. And I think that would probably help us move from the current balance sheet disclosure standard toward a more efficient disclosure standard that would reduce the opportunities for investors to get taken advantage of by unethical sellers of corporate equity. Oh, yeah, this didn't come through very clearly, but if you open this image in another tab and zoom in a little bit on the right, these are the firms represented in the 300 in the sample. So banks, wholesale manufacturing, telecom, and insurance and media were the largest firms. So not a perfect representation, with financial being oversampled, I think, but overall not bad.
But then how is the number of customers tracking 65%?
Yeah, that's a good question.
The index isn't loading well on class web page, by the way. I opened it from the tab and it's not loading well on the laptop.
Oh,
I don't know if this is a newer
no, I shouldn't be. I'm on the class web page. So yeah, that's a little strange. The same table is here in the paper if you want to dive into detail.
So if they could Slack these data, how they analysis and give like marketing department instructions or stuff like that.
Yeah, I think that is probably why these numbers seem lower than what you would expect. I think these are probably accounting department reports of what the accounting department tracks, whereas the marketing department would often be the one tracking things themselves, but they wouldn't be the ones making the disclosures. And so you would think that would be a trivial internal crossover, but usually those crossovers are not trivial. So to wrap it up, customer-based corporate valuation, the core idea is that if we could standardize and move to a uniform set of customer-based reporting, measures, we could better evaluate and estimate company valuations. That would make capital markets more efficient, and it would reduce the incidence of getting tricked by what is disclosed versus what should be disclosed. Okay, I admire my colleagues in accounting even more now. That's not easy to present, but if you stayed with me, that's great. Thank you so much. Okay, so for the folks who might end up watching this on YouTube, the asset pricing game is going to be an in-class experience. It won't be covered on quiz 2. So I'm gonna stop the class video.